Ladies and gentlemen, welcome to Entrepreneurial Finance, valuation of business ideas. This is the process you have to go through if you want to get VC money. So at a certain stage of this process, you have to come up with the valuation, or the VC has to come up with the valuation. You have to agree with the valuation. However, you have to talk about valuation. This has normally been done in the detailed analysis phase, and this is in the very end part of the term sheet. So how do you do a valuation of your company? Let's take an example, WhatsApp. WhatsApp did a couple of financing rounds. The last financing round was done for a valuation of approximately $1.5 billion US dollar. That was the last financing round before this company was sold. The first one was seed money, $250K in 2009 for 8 million valuation. Then afterwards, 80 million valuation in 2011. So they were able to raise the value of their company. And then this final round in 2013. So not really long before this company was sold for 1.5 billion. Why 1.5 billion? Why 8 million at the very beginning? Why 80 million in 2011? That's the main question every entrepreneur asks himself, and you have to ask yourself the same question if you want to obtain VC money. So how do you approach that problem? Well, actually, theoretically, you can do two methods. The first one is you can use discounted cash flow methods, which is basically you calculate the cash flows in the following years and you discount them to today in order to get an idea of today's value of your company. It's quite complex. You need a lot of information for that. However, it's pretty much an exact way of determining the value. Let's talk about whether it works in startups just in a couple seconds. The second way to do evaluation is using the multiple valuation. So the equity value of your company, of your target, is compared to other companies, and what you do is you basically compare to financials of other companies, value measures or whatever, and you multiply your comparables and the comparables of the other companies with the same multiple. This is a very simple method. This is the most common technique which is used in VC valuation if you can find comparable companies. So look at these two ways in a little more detail. Start with the discounted cash flow method. So let's start looking at the DCF method. It can be quite difficult if you do projections for the future. However, it helps you understanding your business model. It helps you clarifying the most important assumptions. The biggest problem in the DCF models is normally if there is no positive cash flows to discount. So there's most likely no CF2D. If you look at those companies, ResearchGate, Outfittery, they do not earn money, at least at the very beginning. They multiple losses. And if you have losses over losses in the following years in this detailed projection period of a discounted cash flow method, actually you can discount that to get a positive valuation. So then the main question is, how long must the detailed forecast period be? However, everybody knows that you can always make this hockey stick and calculate this hockey stick. You just need to make your detailed analysis of forecast period long enough. But knowing anything about entrepreneurship also tells you that projections are normally not possible. So that is the biggest difficulty using discounted cash flow methods. I mean, there's more questions. When will the company achieve positive cash flows? That is when detailed period, or that is how long the detailed period has to go. And what is when the growth rate is, or how do you do the residual value? That's the main question. So you can only do that when the growth rate is low enough. And do you really think it will be low in the following years? What is with uncertainty. So is it possible to project the future? And so on. What is the right interest rate? This is also a question you can ask yourself. So why should you do a discounted cash flow method? Actually, this might help you to explain assumptions and premises when you do. So you do the modeling with different assumptions, and then you look at the assumptions, how they change the value of your company, and then you understand the business model of your company. This is how a discounted cash flow model might help you. However, it probably doesn't help you too much for your valuation. So the advantage is theoretically it works. Theoretically, it's probably the best valuation approach. However, coming with the uncertainty, it is not working. So what you need is scenarios, and if you do good scenarios, you understand your business model. However, this is helping you, fostering your understanding, not doing evaluation. This leads to the disadvantages because you need some detailed planning, which you probably can do, and then the results are highly sensitive. Basically, in many models, you have most of the value in the residual. And having said that, it is really just making guts feeling or something like this. So you can use that if you have some time to understand your business model. It's probably not going to help you too much with the evaluation. The second technique is the multiple valuation method. And there's two kinds of multiples. You can either compare your company, which is these privately held companies like Tesla Motors, to established companies which are traded on the stock market, and say, okay, I'm going to compare Tesla to Mercedes-Benz or Daimler in that case, and use some comparables. However, still Tesla is not making money, so you can compare sales figures, for example, but you have different growth rates in that. So that's the main question. What is a real good comparable company, or are there enough comparable companies you might use? The second sort of multiples is so-called transaction multiples. And you, for example, look at WhatsApp. WhatsApp has been sold recently. So if you do a company like WhatsApp and you want to compare your company to WhatsApp and say, okay, we're doing slightly the same business. I mean, every company is unique, but slightly the same business. And you have X number of users, and what WhatsApp has had Y number of users, you can do the multiple method. This is very simple. The problem is, do you really find those multiples? So the market cap, and this is a discussion point with trading multiples of comparable companies on the stock exchange you use, is sometimes a bit lower because growth rates are different, but this is how you do them. So this is again an explanation, verbal explanation of what we had before, what is trading multiples and what is transaction multiples, and how you use them in practice. So trading multiples compare with companies that traded at the stock exchange, so compare the market cap, and transaction multiples compare the companies to recently acquired companies and use these multiples. The advantages of this method, it's relatively easy. You can try to easily communicate that. It's based on some data, so it gives you kind of like a good idea. And with transaction multiples, the purchase price is often available for transactions where the target is not listed. So you can even do that with privately held companies. However, normally it's difficult to find comparable companies, and it's very static. So normally growth rates of these companies, as I said, are different. So this is the static approach. And if you look at those multiples a little further, trading multiples, you're highly dependent on stock market movements. So stock markets might change. It might change then valuations of companies, although multiples ideally should remain the same. Transaction multiples, you do not really have a good level of transparency because those privately held companies normally do not disclose every information. So in general, you can use these two methods or all the other methods which we introduced when talking about valuation, which is done by business angels. However, when it comes then to the term sheet and the negotiation, it's all about using the right arguments in favor of your valuation or against your valuation. So what you always should do if you do your own valuation, you can try to prepare numbers. However, you have to prepare arguments which might influence your value positively. For example, good customer relations, unique products, or a good team. Especially in the early days of your venture, a good team counts for a lot. Maybe you have some good co-workers, or maybe you have some turnover. You might have profits, normally you don't, but you might have some. And this is the arguments which might influence your valuation positively. This is what you should prepare, because VCs normally come up with their own valuation, and then you should be prepared for discussion. And you should also be prepared for those arguments VCs might take into the negotiation, which is basically the same customer relations, which might not be good enough, or you can't protect your product or service good enough, or you have clients which have a too big share of your turnover, and so on. So this is what you need to prepare. And in most cases, you come up with a number, or the VC comes up with a number, and then it all ends in a negotiation. So is 19 billion a good valuation for WhatsApp? Actually, this is not the question. WhatsApp has been bought, it has been sold for 19 billion, and then this is the right valuation because this is the price. And normally in business administration, nobody asks if this is right or not. If something happens in reality, that's the right thing.